Hi, it's Lee, and welcome to the Tesla Economist. Moving on with the call, Zach Kirkhorn takes over and discusses some of the financials. He talks about margin, saying it was 27.9%, which I thought was actually quite low. It was the same margins as Q2, which had a massive lockdown in Shanghai, along with the two factories doing very little in Q2, and we saw a lot more output relatively in Q3. This I was not expecting, especially when Elon had previously said that Giga Berlin reached profitability in the last earnings call. I think that this means these new factories are costing a lot to run, likely more than the Shanghai factories. A lot of this cost might also be attributed to the 4680 cell production too. So although the overheads of these new factories are higher than Shanghai, I would expect when ramped up, the cost per vehicle should hopefully be lower. And on top of that, of course, they are producing long-range Model Ys, which are more profitable. I also expect that the final capacity to be much higher due to the advanced manufacturing techniques. He does actually go on to say that Austin and Berlin ramp costs weighed on the margins. So it's also the actual cost of ramping the factories up too, but should be better in Q4. In other words, these factories are suffering more cost with less output than they will in the future. And then he says if we remove regulatory credits and Austin and Berlin, then the operating margin would have been the best yet, previously 19.2% in Q1. He does, however, tell us too that auto gross margin would have been nearly 30%. Alright, that does sound much better. Again, Q1 was 30% auto gross margin, so similar there, but better operating margin. This is due to what I have been trying to explain previously, how Tesla has such outstanding operating leverage. Tesla's OPEX increases very little relative to the revenue or units produced. Thus, as Tesla continues to ramp up their production, the OPEX per vehicle keeps reducing, hence such incredible operating margins. Zach goes on to say that whilst small and growing, each car they build in Berlin and Austin is contributing positively to profitability. I'm surprised by this. I wouldn't have thought Texas would be profitable yet. In fact, that is actually amazing that Texas is already profitable at such a low production rate. It must mean costs are very low, and possibly gross margins on the vehicles will be high, as cost of goods sold will get much lower. But the numbers I run seem to point more in the direction that Texas lost around $200 million this quarter. So I think he is talking about the fact that Texas is now contributing to profitability, given that they are close to around 2,000 units a week. But on average for Q3, Texas likely did generate a loss. Also, I'm not entirely sure if he is factoring in the cost of Cato Road facility there too, and the cost of production for the 4680 cells. I would assume so. But either way, it sounds like a run rate of 2,000 a week is about break even for Texas, or perhaps a revenue of around $1.7 billion a quarter. Anyway, once Tesla also receives subsidies for their battery production, this will also rapidly improve. I still think margins are lower than they should be though. We had 30% margin in Q1 without regulatory credits. The prices of vehicles have increased about 10% since then. He does explain further that they have been facing macro headwinds. He lists raw materials, logistics, and foreign exchange was a big part of this last quarter. This is a shame. We can only imagine how well Tesla would be doing now if the world was running at a more normal rate. Although Tesla do source as much as they possibly can locally, it would mean that the dollar is affecting their margins too. Perhaps they have mining contracts that are in US dollars, for example. We would hope that this all passes, but will likely continue to be an issue for a little while. However, the fact, despite all this, that Tesla are still achieving 30% margins is remarkable, really. I don't know how many of you recall when Tesla first were hitting around 30% margins, and how impressed we were then. Let's not forget that. But these new factories ramp up within time also and generate even better margins with their lowest cost of production and highest value product. Then, of course, the Inflation Reduction Act for the US. Then on top of that, like I keep reminding you, the operating leverage of when they hit volume production. Not to mention the almighty Cybertruck, which when in volume production could have the best margins out of anything. I'm not entirely sure though that the semi-truck will have great margins, at least to begin with though. Anyway, if it's this bad for Tesla, how much worse must it be for Legacy right now? We hear that Tesla achieved their highest profitability in energy this quarter and is attributed to increased volume in Megapacks and Powerwall products. I actually estimated these figures right, except I attributed the profitability to Tesla moving over to LFP cells instead of using the more expensive 2170 cells. And I'm sure that is a part of it. But not only that, did you know that Tesla's Megapack factory was actually already online and recently built, the one in Lathrop, California? Tesla didn't make a big deal about this. It was just mentioned in the Q2 earnings report. It has a capacity of 40 gigawatt hours a year, and we saw Q3 jump from about 1.1 gigawatt hours deployed to 2.1 gigawatt hours, almost double increase quarter over quarter. So I expect we finally will see energy grow at a good rate from here. Then we hear about the cars in transit and how Tesla have been experiencing limitations on outbound logistics capacity, which was not anticipated. It's broken down to shipping vehicles from China to Europe and local trucking within certain parts of the US and Europe. If trucking becomes a bottleneck because the vehicles are so popular, then you know Tesla and what Elon says, they will get into whatever industry is necessary for the mission. Well, Tesla are going to also be making semi-trucks. So is it possible Tesla will start using their own trucks to deliver the cars? They even mention 50,000 semi-trucks by 2024. I thought that was a lot. A number I was very surprised about. Probably about 40 to 50 gigawatt hours of cells to achieve that. That's a lot of batteries in just a couple of years, in addition to everything else. The historical operating pattern of Tesla's batch building by delivery region leads to extreme concentrations of outbound logistics needs in the final weeks of each quarter. And to put this in perspective, we are told that roughly 2/3 of Q3 deliveries occurred in September, and 1/3 just in the final 2 weeks. As a result, Tesla have begun to smooth regional builds throughout the quarter to reduce the peak needs for outbound logistics, which will simplify operations, reduce costs, and improve customer experience. But it might mean that we see more discrepancies between production and deliveries in the future. Tesla's production numbers are growing exponentially. It's one thing finding ways to deliver an additional 20,000 vehicles from the previous quarter, but when it starts to approach an additional 100,000, that's not so easy. But remember, as investors, production is what matters. I think that means we can infer that some people's production estimates of around 400,000 for Q4 are incorrect. Zach then says, as we look ahead, plans show we are on track for 50% annual growth in production for this year. Wow. And we had Elon saying how Q4 will be epic too. My rough guess to Q4 production previously was around 470,000, but let's calculate what 50% growth would actually be. 2021 production was 930,000, so a 50% increase is a fraction below 1.4 million. We're up to 930,000 produced this year, so that would mean we need 465,000 produced in Q4 to reach that target, which is an insane 27% growth quarter over quarter, presumably due to these line upgrades in Shanghai in full operation, and some more ramping from the new factories and Fremont too. Those numbers are totally achievable, assuming no lockdowns or anything like that, and they do mention supply chain risks, which are out of their control. It sounds unlikely that deliveries will be higher than production. Historically, Tesla has pushed out end-of-year deliveries. On top of that, there are an additional 22,000 vehicles produced last quarter that were not delivered. They do, however, expect to be slightly under 50% growth when it comes to deliveries. For 50% growth in deliveries, Tesla would need to hit 495,000 delivered in Q4. So to be just under, then maybe 470,000 is a realistic possibility. But who knows what can happen? We're told to expect a gap between deliveries and production again though. So if it is a similar gap, then we're about 450,000 deliveries. However, that would still be slightly over 30% increase in deliveries from Q3. So one would expect Wall Street to take notice of that. But lately, Mr. Market seems to be suffering very bad from his bipolar disorder. And finally, to reinforce what Elon said, they are continuing to make as many cars as possible whilst maintaining operating margins, which is why Tesla is such a good investment. There's still so much more demand to come, and they're going to remain highly profitable. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.